Capital budgeting, also known as an investment appraisal, is a strategic planning process employed by businesses to assess significant projects for investment decision and determines their financing methods. These projects encompass substantial investments such as constructing a new facility, acquiring new machinery, creating a new product, or purchasing another company. These extensive undertakings are also referred to as capital expenditures. With this in mind, capital budgeting involves a comprehensive financial evaluation for each potential project. Typically, the company initiates the process by estimating all anticipated future expenses and revenues for each project. This estimation incorporates a crucial factor known as the hurdle rate, often selected as the discount rate. Subsequently, the company proceeds to compare the outcomes of each project, ultimately selecting the project that promises the highest potential profitability. For example, Phones is considering venturing into the microsims industry. To make an informed decision, it employs capital budgeting to assess the feasibilities of manufacturing its own microsims versus acquiring an existing microsims manufacturing company. After careful analysis, Phones determines that developing the products internally will require a 5-year period to achieve break-even and will yield an internal rate of return of 10%. On the other hand, acquiring an established microsims manufacturer will recoup the investments in 4 years, but will yield a lower rate of return at 5%. Based on the comprehensive capital budgeting evaluation, Phones' management team opts to proceed with the in-house development of the microsim.